So the next paper on the agenda is not really the next paper because Sean Foley is not there. So his paper, which was originally scheduled for tomorrow, is going to be presented now. So that's Madhu. Please go ahead. You have 15 minutes.
So I'm back from future, in some sense. And thank you. Thanks for accommodating us and Susan and the team for letting our paper present today, and especially reconnecting to a lot of old friends and making new friends here. I think that's the best part of being here, home turf. Pradeep is not here for a good reason, I think. Okay, so this is unlike the two other papers. This is very new, very raw, and I'm sure my discussant is going to have a field day. Okay, so I'm just going to keep it very simple and see what I can get from this. Okay, I think the story is pretty simple, really, and so the leverage story never ends. Had it in US, North America, Europe, and then now the debt crisis is sort of reaching the emerging market. So this is from The Economist 2 years ago, and that's exactly what we're trying to study. Is it really then? How is it really going to then impact the emerging markets? So I think this particular question bears an interesting sort of contextuality given what is happening in the emerging market. So I'm just going to present 3 thoughts that you see in the IMF, BIS sort of literature, right? One is obviously how high the non-financial corporate debt has risen in the last 7 years as a percentage of GDP, and more so if you include the shadow banking debt. And then how such an increase in debt would have more amplified effects arising from the mismatch of the currencies in how the revenues and the debt are matched, really. The currency mismatch amplifying the risk, and more so in terms of maturity, how the increased borrowers' interest rate, rollover, and currency risk in the context of emerging markets. Okay? And then there are all these warning signals about how companies, the non-financial corporations, would do this huge debt, offshore debt issuances, and then transfer back those funds to the home country, via these 3 channels. So either they are transferring those funds to their own headquarters, or they are lending to other sister companies, or they are transferring those into the local banks. So the bottom line is that the moment they are transferred to the local banks are also sort of getting hooked onto this huge explosion of debt. And a couple of quick pictures to show how high the foreign debt issuances have been from the non-financial corporations, and that number, if you can't see, is about 1,000 billion, it's about $1 trillion there. Okay, and not only that, a lot of this growth in the debt is actually happening through foreign currency debt versus the local currency debt. So in India, there's a big talk about masala bonds, which Viral was talking about. That would be the lower one, but really the key thing that Economist article, for example, talked about is the explosion, so to speak, of the foreign currency debt. Okay? And then it is not simply the debt that is growing, but it's a leverage to sort of standardize with the underlying assets. You can see that there has been an explosion of leverage, right? So then the story is then not only there has been an explosion of debt and the leverage across the emerging markets, but there's also a big cross-sectional variation. For example, China is somewhere here, close to 200% of GDP, whereas India is about 50% of GDP. So, and then there are so many other Latin American countries which also have experienced such increase in leverage. So we really do 2 things here. We investigate the potential fallout from the post-crisis increase in corporate leverage, and that has been the sort of key theme in the IMF, BIS sort of thing. Really, a lot of this explosion of debt and leverage is post-crisis. We asked really 2 questions. Did the post-crisis buildup in leverage affect the firm-level distress, okay, in emerging markets? And if so, what are the different channels, firm, industry, market-wide channels, through which the corporate leverage might have impacted the credit risk, really? Okay? And as a result, we sort of, what we think, offer a comprehensive study of escalating market corporate debt, and overall it contributes to the literature on emerging market debt and helps shed light on this. So somebody might ask me, really, are you contributing anything? I think we're not contributing anything methodologically, but somebody has to do the work, so we are doing it. Okay? So that is our humble sort of point here. So then I think although greater leverage, I think this is interesting that although greater leverage can facilitate higher corporate investment and perhaps stimulate growth, we know that typically the crises in the emerging markets have been preceded by such accumulation of corporate debt. And perhaps the growth, or it's also possible that there are potential growth opportunities that can mitigate the increased risk premia. So it's not very clear that is leverage really causing the distressed risk to go up. On the other hand, because of the implicit growth opportunities, the distressed risk increases has been actually being mitigated. Okay? So we sort of provide the first quantification to the best of our knowledge of such post-crisis leverage effect on the underlying credit risk. Just flash these 3 or 4 findings to you. One thing interesting, so sort of you document the summary stats out there, along with the increase in the net debt. So these are sort of yearly numbers. Some of the key performances of the firm performance metrics have declined. So that would be the market to book. Again, I want you to focus on the post-crisis and the interest coverage, the ability to service interest payments. Okay, so that have deteriorated. And so too, for example, Tobin's Q to some extent, and the ROA, the return on assets. So again, this is the firm level variables across the emerging markets. But then, if you actually look at how credit risk has sort of reacted or evolved, and if you were to measure the credit risk using 3 proxies, so the 3 proxies we employ is the CDS, credit default swap spreads. The second metric is the probability of default. The third metric is distance to default. I'll say a little more about that. So the first thing is that we really don't see any spike in CDS spreads at all. Been pretty flat out there. If you look at the probability of default, which is sort of model intense, so it's sort of conditional measures which are dependent, conditional on the underlying covariates. We see definitely a spike in probability of default, and in the distance to default, which is really how close you are to default, that decrease has happened only in the recent past. So we see some scent of distress risk in the distance to default in the last few years, but definitely PD has spiked up, whereas we don't see anything going on the CDS. Okay? And there is a story behind that. The second point here is there are really strong regional effects. If you sort of cut it across regions, so Asia, EMEA, and Latin America broadly, and here we are simply looking at CDS spreads of those 3 blocks. Again, the CDS spreads are pretty flat and for Asia. And for the EMEA, actually, the CDS spreads are, in fact, there's nothing to really brag about. They're sort of, again, going down. But we do see a big spike in CDS spreads for Latin America. So it's as if the economist story I started with could have a particular bearing. We have a friend from South America. He's here somewhere. Okay, so that could be a sort of alarm bells for Latin America. Okay, now and then there are a lot of cross-sectional differences in how leverage has evolved, and sort of not going to that. Again, if you do the same repeat story on the PD, probability of default, nothing going on EMEA, but you see a big spike in Latin America and a reasonable spike in Asia. Okay, and then if you do the distance to default, again, nothing going on EMEA, but you see a recent drop in distance to default, signaling increase in distress risk for Latin America and likewise for Asia. Okay, so the story is regional. That's all I'm saying. So if you sort of subject this to 5 minutes, okay, so if you do go through this conditional test, so bottom line is that, so if you do this fixed effect robust estimations, So the post-crisis increase in leverage has significant impact on two of these measures, as I said, and it's sort of localized to these two markets, Asia and Latin America. The leverage also seems to impact the PD slope, probability of default slope, and that really is a sort of proxy for credit risk expectations, how they're going to evolve in the future. There's a significant impact of aggregate variables, as you would believe from the local market returns, and US-related risk aversion and aggregate default factors on this. And there is also another interesting thing that if you sort of subject this to a little more torture, you see that though if you sort of run PCAs and averages, though an aggregate it seems as if the increase in leverage seems to impact these credit risk measures, if you actually run panel regressions, the impact of, you see that a lot of firms actually increase leverage, but it doesn't necessarily increase their credit risk. What I'm trying to get at is there is a lot more cross-sectional variation in the debt story here. Additionally, we sort of process how these effects are going to be reflected in this credit risk. So for example, the importance of firm and credit industry risk seem to matter quite a bit. So firms, larger firms with a higher valuations, signifying higher growth prospects, can significantly lower the leverage effects on credit risk. Similarly, firms coming from the tradable industry, which tradable sector would be those which can sort of export their goods and services across the borders, they seem to have a lower impact of leverage on credit risk. There's a big impact of country-specific factors. So countries which actually experience higher capital flows and had favorable exchange rate valuations, for those countries, the effect of leverage on credit risk is much lower. Okay? And the countries, again, with better governance also had a better impact of credit risk on the leverage on the credit risk. So what are the implications for India? So if we sort of cut this down to Indian sample, again, the story for CDS is as before. You don't see nothing happening on the CDS. But you definitely, again, see something very interesting, big spike in PD around the taper tantrum, okay, around the taper tantrum period, which was a big sort of a currency problem for India. And again, you see a similar distance to default that's happening. So the story here is, though leverage has spiked up for Indian firms, that effect of leverage on the credit risk was more of a recent taper tantrum regime that happened. Now, our results also have a little bit of bearings on the systemic risks out there. So we sort of look, so this is from our other paper, so I'm going to show you a better picture. The story there is that, as I said, so again, this is an Indian audience here. So if you look at the golden line, which is India, so the fact that the systemic risk actually were going up for India only recently in the taper tantrum and the recent bankruptcy period, those spikes in the systemic risk, a lot of that was actually also happening because of increase in probability of default. So the story is that the effect of leverage on credit risk is a big deal for Indian firms, not generally, but during these episodes, recent episodes, where there was underlying sort of shocks that were administered. I'll just, how much time I have? I'm done. Okay. So there's a lot of discussion. So there are about 21 tables in this paper. So I'm just going to give you one intuition. So we thought quite a bit about all this. So this is the key thing. So credit defaults, so the question is, how do you measure distress risk? So people will ask me, why don't you use bond spreads? I mean, I have some sort of work quite a bit with bond spreads. So I think for now, we're using CDSs in sort of balance sheet variables. The point is, the credit default swap is really sort of an amalgamation of probability of default and the recovery. So my intuition here is this, that though investors think that increase in leverage would increase the probability of default, but there are probably high growth opportunities in these firms, especially in Asia and so on, which mitigate the increase in probability of default. So on one hand, there's a PD goes up because of higher leverage, but probably the investors think that there are higher growth opportunities, and those growth opportunities is reflected in higher recoveries, which would dampen the CDSs. So I provide some intuition in the paper about that. So overall, I think that the story we want to really lay out here is it's really a conditional story. Thank you.
The discussant is Sushanta Malik. You have 10 minutes.
Had many email exchanges because, as you know, Madhu clearly mentioned that it's work in progress. So I received several versions, and so eventually this one also, my writing also has become more of an evolving nature. So this is a very interesting paper. I enjoyed reading it. Yesterday we were talking about lack of access to finance. Like companies are constrained, they don't have access, therefore we need greater access to finance. And which is important, it's good for firm growth, and therefore it's good for overall economic growth. Here, we're talking about too much of finance. Okay? When you have high leverage, you have a possibility of credit risk. Credit risk is bad, and we need to understand where to strike a balance. At what point, what is the threshold level? It's very hard to define what is the threshold level, and which can differ across sectors, across industry, in different categories of firms, and so on. So therefore, it's important to understand what are the driving forces for this buildup of leverage. Now, what we see here in this paper that there is this increase in leverage since 2010. Okay? And how it happened? It happened because companies wanted to switch to the bond market, bond investment. There was not much return in advanced countries. Therefore, they are moving into buying emerging market corporate bonds. And that explains why it went up from 73% to over 100%. And but this information is for 23 countries or 23, yeah?
This data is actually
not yours. Okay, so this number can vary. This number can vary depending on the sample you use. But I had looked at this data until 2007 for 48 countries. We had found like around 50%. The leverage was 50%, which would have gone up clearly. But in any case, there is a big increase in leverage since 2010. Now, it's important to understand what impact it has on the different measures of credit risk, which Madhu has done very well with well execution of the econometric analysis. But I will have some comments on and how to improve these channels or explanations as to how this is contributing to increase in credit risk. So that's the 350 firms from 23 emerging markets over this time period. That's the data set. What it finds is that during the post-crisis period, leverage increased the probability of default of these 350 firms, and which means it lowered the distance to default. So it's basically inverse of PD is the inverse of distance to default. So this leverage, however, did not have any significant effect on CDS spread. So these are the three different indicators of spread, risk, but CDS was not influenced, but as Madhu explained, that it is increasing the spread in Latin American countries, but not in the other two regions. What the interesting part here is that the two-step selection model that Madhu has used in the first stage, using a lot of these firm characteristics and the lagged values of the credit risk indicators, he has looked at whether there is any kind of correlation between the selection equation and the regression equation that he has in the second stage. So what looking at the inverse Mills ratio, you find that there is a correlation between these two. So therefore, there is some bias in case of only trying to understand this distance to default, but not for the other two risk measures. So I have some comments on the data and so on. So maybe that will help explain why this is coming out, why this kind of difference is there. Now, first thing is leverage definition. Yeah, thank you. So the leverage, clearly, I mean, one thing I don't know why it is coming around 20%. If you look at all the figures, all the charts that Madhu showed, that the leverage ratio remains around flat in the 14 to 22%, and that's the range within which it fluctuates. So therefore, I was wondering why it is so low. Because we know that it's much higher than that. One reason could be that you are using net debt, but it would be important to combine it with also the total debt ratio or debt to equity ratio, just as a robustness, if that is the scenario there. Now, crisis definition, maybe it is important to consider 2007 as pre-crisis year rather than crisis year, because really you did not see financial distress at that point in time, but we did see in 2008. And if you look at all the indicators, you don't see a sign of kind of crisis in 2007. So you could club them during crisis until 2007. This point is, I'm a bit concerned. I looked at the equation there. See, the probability, let's think that P is the probability of default, that a company could default on its obligations. Then 1 minus P is that it will not default, right? So here you have, this is like a CDS spread, and this is the recovery rate. And that can be determined by a number of factors, number of variables will explain that. And there are models, actually, very complicated models to determine this, and then therefore you. So this equation I took from your paper. So when this CDS spread and the probability of default, these are two indicators of credit risk, when they are correlated, why one is significant, other one is not. PD is significantly increasing when you have increase in leverage, but not CDS. CDS spread doesn't increase. So that's one thing which you can look into. What could be the explanation for that? I want to make another 2 quick points. That the methodology, you could actually have a small t and large n, so you could use, thank you. You could use a dynamic GMM in addition to fixed effect regression to see if the result remains or survives. Now, another point I want to make here is this, it doesn't matter, even if you are an innovative firm and you have high leverage, you are more productive, it doesn't matter. So the leverage could still be high for more innovative firms. So therefore, it would be good to separate these all 350 firms into 2 categories, more innovative and less innovative. Maybe the leverage will not be a problem, it will not increase credit risk. So to do that, because you are doing this, although of course you have industry dummies that would capture all the unobserved heterogeneity at the industry level. So what one could do is, in addition to that, you could have R&D spending across industries, aggregate all the R&Ds in a particular sector, and then use that in addition to the industry dummies. That could reflect the innovativeness of a sector. Therefore, leverage might not increase credit risk. Or that could be, you could think of, if you have R&D spending for these individual firms, you could interact the two. And that could actually reveal some kind of channel as to, is that a really risk for, because leverage, just looking at the number is not high enough, but is that a problem for more innovative firms? Secondly, credit rating is also equally important. If you have information for these 350 firms, the credit rating of each one of these firms, that could be used in addition to the leverage, and see whether the firms with investment grade rating are experiencing higher credit risk due to leverage or not. Okay? And this paper, actually, we did that. Of course, there are a number of other things, organizational capital, intellectual capital, and so on. So I don't have time. And let me just make one point, then I'll stop. This data, this is an important point. Of course, so this PD and ETD, they are coming from CRI, and they don't give the identifier. So how these two data sets were merged, because your financial information is coming from one side, and these credit risk variables coming from this data source, and because there is no common identifier, how this was resolved in merging these two data sets. If there is something wrong in merging, then that could also influence the results. So I will kind of I'll stop there, and there are some questions. So basically, this is an interesting paper, and it's an important issue because we need to understand how at what point leverage should be stopped, and it can vary across industries and so on. And the econometric analysis has been well executed. Clearly, there is a regional heterogeneity that we see with regard to the leverage effect of credit risk, but some more could be done in order to explore the mechanisms further as to why leverage significantly influences PD but not the CDS. Thank you.
Thank you, Sushanta. So we basically just have 2 minutes. So let's just collect questions and you can have discussions offline. So we have time for 2 questions. Yeah. I knew Josh would ask.
Madhu, interesting paper. I struggled a little bit with the motivation for your analysis. So I see that leverage is up as you showed, yes. But is it optimal? I mean, it's possible that for a variety of reasons, that's exactly what firms should be doing. Exactly. There's been excessive central bank intervention. They've kept rates low. Volatility is very low. So all this would imply that perhaps taking on more leverage is optimal. So have you looked at some sort of multiples for stock valuation to examine whether these decisions are increasing firm value or stockholders' returns? And do you need to control for how the revenue side of or the asset side of the corporations have changed over time? With globalization, you would expect that more of their revenues are denominated in foreign currency. So having foreign currency denominated debt would be optimal to reduce risk. Are there some ways in which you can incorporate these ideas?
Josh, very quickly.
I'll be very quick. I think one problem with the paper may be excessive reliance on CDS spreads. CDS spreads are very, very thin. They're typically quoted only for a few companies, typically only the best companies. So it's going to be very, very difficult to identify countrywide stress amongst many, many firms in a country with CDS spreads, which show stress in only a few of the best firms of that country. So I think you might want to explore other measures of stress beyond CDS.
Thanks, Josh. And since I'm moderating, I'll take the liberty and ask one question. So there could be one potential endogeneity here, because, for example, in India, we know that firms were, because of macroeconomic stress in the post-crisis period, firms were actually taking on more debt from the banks. Because they were stressed, they were not able to repay. The banks were evergreening and helping the firms stay afloat. So the debt equity ratio actually went up because they were more stressed. So that would definitely be a feedback effect from your credit risk to leverage and back to credit risk again.
Yes. Okay. So quickly, so I'll just go in the reverse order. Rajeshwari is right here. So we do the sort of Heckman, we do the reverse thing. So we do, again, the best of abilities, we do the endogeneity test. Okay. Josh, about CDS, I completely agree with you, Josh. So we know, I worked quite a bit with CDS, so I know the liquidity issues there. So my reason in using CDS is not because it's great, but it's exactly the opposite. That's one measure of it out there. And that's exactly why we have a more potent measure, which is probability of default. It's absolutely model intensive, and I can say more about it. If I do find smoke in the PD, controlling for all, then I think it's a better story than CDS. I completely agree with you. Going to Kumar's question, so leverage, Kumar, we actually sort of look at all the balance sheets data, basically data stream, because over 350 firms or 23 countries. So we actually look at firm level leverage, which is really all the net debt, which includes domestic and foreign debt. And the denominator is all the assets it has. So I cannot really distinguish between local and foreign merging, but that's the best I have. I will definitely talk to you a little more about the multiple stock valuations. I didn't get that. And your story is right. I think there is a growth potential. There is a Q factor. So just because they are taking more risk, more leverage, in fact, it doesn't mean that the spreads, the risk is going up. So just to sort of backtrack, what we are trying to say is, look, if you look at all the IMF, BIS, there is a lot of noise, sort of a lot of warning signals. We all had a paper on from the Brookings Institution, which actually was put out a couple of years ago, which said, look, there is a real panic mode we are in. The question we're asking is, are we really in a panic mode? The answer is, it depends. So I'm not saying that just because they're taking more leverage, the risk is going up. In fact, there may be more capacity for them to do that. That's exactly what we are trying to say, okay? And going back to my discussions, questions, I think they're all well taken. You spend more time looking at it, so I'll sort of discuss with you outside. Thank you so much.
Thank you, Madhu.